Everybody wants to make money from their phone, but nobody wants to learn how money actually. And this is where most people lose. Good day, everyone. I'm Forex Doctor, and in this video, I will not just show you how to trade, but I'll also be showing you how to think like a market. Because once you understand that, you don't chase money anymore. Money will start chasing you. Let's get straight. So today we're going to be looking at introduction to forex trading. Okay, we'll get your writing materials and everything. Which parts as well. Now, what is this forex trading talking of? Forex trading is actually the act of exchanging one currency for another. Okay, with the goal of profiting from fluctuation in currency value. Okay, just your normal exchange. Okay, and the aim is profit. So that's what forex trading is about. Okay. And then it's also the buying and selling of currencies on the foreign exchange market. Now, when you hear forex, it means foreign exchange. Take note of that. Okay. Now, that foreign exchange market I made mention of, is actually a global and decentralized marketplace. Okay, where national currencies are actually being bought and sold. Okay, and it is the world's largest and most liquid asset market. Take note of that. The world's largest and most liquid asset market is the forex market. Okay. Now, moving into trading, we have types of trading. Okay. Let's move on to the part where I wrote. So in trading, we have five types of trading. Okay. We have scalping, day trading, position trading, swing trading, and algorithmic or automated trading. Okay, good. These are the five major types of trading. Okay, good. Now, scalping actually involves holding trades for seconds to minutes. Okay, holding trades very fast with the aim of profiting from very small price movements. Okay, from seconds to minutes. Okay, if you enter a trade within 10, 5 minutes, you're done. Okay, 3, 5 minutes, you're done. Okay, that's scalping. Day trading is actually opening a trade. Okay, it's a system of trading whereby the trade is open or closed within the same day. Okay, capitalizing on that day's volatility and momentum. That is day trading. Okay, inside that day, maybe 4 or 5 hours, 2 hours. That is day trading. Okay, swing trading involves holding trades for several days or weeks. So we are holding trades maybe 8 days, 10 days, 1 week, 2 weeks. That's already up to a week. Okay. So that is swing trading. Then position trading, this system of trading, trades are held for like weeks to years, weeks to months, sorry. Okay. Sometimes even years in position trading. So you hear people say, I've been holding this trade for 2 months, 3 months. That's position trading. Been holding this trade for a year, 2 years. Okay. Then now algorithmic trading. This one could either be scalping day or swing trading, okay, but it's executed automatically. As the name implies, algorithmic or automated trading. It is executed automatically using bots or scripts. It's just the way you have ChatGPT there to solve your stuffs and everything. There are also trading bots that are here to help you trade based on a set um, program rules. Okay, a trade-based program rules that has already been set. Now let's move into something very, very crucial in trading. It's called candlesticks. Okay, candlesticks. Let's expand this. I tried to write some of them down before making this video. So let's expand for you over all this. That's where I would get everything out perfect. Candlesticks. Now, what are candlesticks? What are candlesticks? Maybe you're thinking some people are already like, candle at home. Did they use candle to trade? Come burn your laptop or put yourself on that candle and say they use candle. This is actually a way of showing price movements on the chart. Okay. They actually show price movements on the charts for a set time. And when I say a set time, I mean maybe 1 minute, 2 minutes, 3 minutes. Okay. Everything you saw on my chart, all these things are candlesticks, okay? And now when I say for a set time, look above here, look, follow my cursor, you're gonna see there's 1 minute, 3 minutes, 5 minutes, the rest then H, 4 hour, 5 hour, day, week, month. So this is 4 hours. So it means each and every one of these candlesticks here opened within 4 hours. Okay, they open and close in 4 hours. Okay, it took 4 hours to create every one. Each one, 4 hours, 4 hours, 4 hours. That's what it means. Switch down to 2 hours, they will show you more. Okay, these those ones were created in 2 hours. Okay, so inside every 4 hour, there's 2 2 hours. Inside every 4 hours, there's 4 1 hour. You get what I'm trying to say? You get the logic now. So now these candlesticks are divided into two, bullish and bearish. Okay. Bullish now actually means, or rather known as buy, the green one. Most that's why I drew this thing. Most people might not understand it from this. Most people when they see green, they know it's going up. Red, it's coming down, it's selling. So the green is bullish, and red is bearish. Now when we see bullish, why did they use the name bull? Why did they use the name bear? Okay, most people will be asking that. For bull, when a bull wants to get some actually picks the person up from the ground and takes the person up. You can see, okay? It starts from the ground, goes up. Or a bear will pounce down on you. So it starts from up and come down. Okay. So bullish means it's going up, it's buying. Bearish is coming down, it's selling. So mostly denoted. You can change the colors, but okay, after when you've learned from so far, me, I understand everything here. That is why the primary color when you open your own chart, you're seeing green, red. Okay, good. So for the whole chart, there are four types, four parts on a candlestick. You have actually have two parts, okay, body and wick, which are also subdivided into two sides. Okay. So for the body, this is actually this part that is filled. Okay. This part that is filled. Okay. Then the long this thing line is the wick. Okay, good. You can see the wick here on these ones too. Okay, good. So for the body, you actually for the bearish part, for the bullish candle, sorry, the green. Like I said, it is buying, so it's starting from down, going up. A bull starts from down, goes up. So for the body part, it's divided into open and close. So for the open, it opens from below, closes above. Open below, close above. While on this bearish candle, if you open above and close below, close down, lower than it started. Okay, that is selling. Now, for high, for the sorry, I said for high. Sorry. For the weak part, now the weak is this WICK, not the weak when someone says he or she is weak. WICK for weak. Okay, just like the movie John Wick. Now for the weak, you actually have um high and low. Okay, for the weak. So the top is the high, low, low. Same for here, so it doesn't switch like this body part. Okay, so here is high, here is low. Okay, so on this part, you can see, it's safe to say here is a high. Below it, this one doesn't really have wick down, so it is low. The body, this one is coming down now. So here it is the open, close below. Okay. So that's it about candlesticks. Okay. Now there's something called lot sizing. Okay. It's actually a lot is actually the unit of trade. Okay. Or actually a unit size of trade. So let's pull this out and talk about it. Lot size. Okay. I said I wrote everything. Speaking of it, I'll have to like get the particular one. So for lot sizing, we have four types of lots. We have standard, mini, macro, and nano lots. So there's a chart for lot sizing. Okay. Okay. So you could just go on it and Google and Safari, any browser, just search lot sizing, types of lot sizing chart. Okay. You're going to see it. So LOT, lot size. So about lot sizing, it actually determines how much you are trading and how much you will lose per pip. Okay. When we say pip, 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 when we say PIP, pip, I, let's talk about pip. Pip actually stands for percentage in profit. Percentage in profit. Okay. Good. It is the standard unit to measure how much a currency pair has moved. You see all these numbers, they are telling you something. Now, let's take an example. For most of currency, let's just use a basic example. We have numbers like this, okay? Maybe 4 digits. This has five. But let's take it this way. Now, if this thing moved from 76 to 77, that's move one peak up. 78, two peak, 9. Then 80, you can see. Okay. But by the time it's from 76, it comes down to 75. It's losing one peak, using by one peak. Okay. Go down to 72. Okay. So that is it. That is it. Okay. That is it on peak. Okay. So is that moving that this thing? So he said if a trade now moves from maybe 1.8005 to 1.806, that is one peak like that, up, down. Okay, that is one peak. Now, this lot sizing will now determine how much you are making at moving up or down. Okay, if you are either buying or selling. Now, you have your standard lot. Okay, let's talk about the standard lots now. Let's use the volume to represent them. The volume now of the standard lot is 1, the 1.00. Mini lot is 0.1. Macro lot 0.01. Nano lot 0.001. The nano lot is rarely used. Okay, mostly standard mini market. So on a standard lot, which is the highest, if you're using 1, it means, let's say a trade, let's do that example again. 4, 5. Now, if for a standard lot, it means that for every one peak movement, you are making or losing $10. So if you are buying and you are expecting it to go up, if it moves from 45 to 46, you are making $10, 47, 20, 48, $30. Okay, that way. But if it's a mini lot, you are making $1. So if you move from 45 to 46, you're making $1, 47. You get the logic now. For macro lot, you're making $0.1. So as it's moving now, 46, $0.1. You get, and for nano, $0.01. So you get the logic now, you get the gist. So standard, the higher your lot, the higher you're making. But the thing is, you need to know how to move between them. Okay, what fits your account? You cannot be trading a $50 account now. Want to use one standard lot, which is 1. If he just moves, maybe it moves against you, just maybe 60 from 69 now, it started going 68, 67. Before you reach down, just 5 times, your whole $5, your whole $50 is gone. Okay. But by the time you're using a mini lot, which is $1, you would have to take 50, so you get the logic now. Okay. So it regulates how much you are earning or how much you are losing. So you actually use your lot depending on the kind of account you're trading. Maybe you can be trading a $10 account, $20 account, 100, 1,000, $100,000 account. Next, with that lot governs how you manage it. Now let's move on to forex trading session. In forex trading, we actually have 5 major sessions: London session, Frankfurt session, New York session, Sydney session, and Tokyo session. Good. So for London session, let's start with Tokyo session. This session is actually a period. When we say sessions, they're actually periods in trading, okay? Time frames in trading. Now, for Tokyo session, it's also known as Asian session. It actually starts in the morning using African and Nigerian time to be specific, within 12 a.m. to 9 a.m. every day. That's when there's high trading activity. When it's 12 a.m. to 9 a.m. now with Nigeria, using Nigeria as a case study or as an example rather, um, when it's 12 a.m. to 9 a.m., that's where there's high activity in the Tokyo trading market, or high activity coming from the Tokyo side or the Asian side. Okay, but when so take note, Tokyo session is from 12 a.m. to 9 a.m. Immediately after that follows London session. Okay, let's move on. So if we're going into London session, for London, all right, I have to tell you something. So London session actually begins as the Tokyo session is about to end. Okay, so the London session holds between 8 a.m. to 5 p.m. GMT, which means That is London session. And trading activity is highest in London. Okay, within 8 a.m. to 5 p.m. Nigerian time. Okay, the Frankfurt session is named after the German city of Frankfurt. Okay, so it's basically talking about Germany. It's not really talking about as included. Goes between 7 a.m. to 4 p.m. 7 a.m. to 4. New York session now begins as the London session is halfway. New York session is about that. New York session now represents the US. It begins between 1 p.m. to 10 p.m. 1 p.m. to 10 p.m. And that's when trading is much in the US. Then we have Sydney session, which is also known as Australian session. The first to open after the weekend. So, again, at the starting point of the global market. They actually start 10 p.m. in the evening. 10 p.m. Okay, and closes by 7 a.m. in the morning. Now there's something we call session overlap. So sessions tonight. Now in this session now where London, London and major overlap is London and this is where sites from the US and UK are quickly or actively involved in trading market. Okay? There's going to be high liquidity, high volatility in the market. Okay? So when those sessions, you notice the times I mentioned, there are some that collide. Okay? That's where an overlap occurs. Okay, an overlap occurs. So for New Tokyo and New York, Tokyo and London actually has an overlap. Okay, as where most activities come from the Asian side and European side. Asian and European currency they move very fast because people are actively using them in that period. Sydney and Tokyo session. Okay, is ideal for like very good early in the morning trading. Okay, so so moving on, we have types of forex. Actually, have five. Whereas them five different types of forex. So we have the crypto, we have the synthetic, we have the currency pair, we have the stock, and we have the commodity market. The crypto market, you know, already know crypto. When you hear crypto, your mind is really going to Bitcoin, Ethereum, Solana, XRP, Bitcoin. That is crypto. It's actually from the buying and selling of digital currency. So the same way you buy Bitcoin and in forex market, Bitcoin can be traded in crypto market also inside forex market. We have synthetic indices. It's actually a simulated market. It's not a real market. But it's offered by brokers like Deriv and Vantage. Or you get to mostly by Deriv. That's it. So this is an artificial market, not a real market. It's taken from it mimics the way the real market is traded. That's actually what it is. Then we have currency pair market. This is major everyone everyone trades. Now the currency pair market is divided into three. You have the major pairs, minor pairs, and exotic pairs. So major pairs are pairs that have USD. Then when we say a pair, it's like two currencies coming head to head with each other. We have Euro USD, like that chart we are on now. Explaining Euro USD. This is where Euro versus US dollar. Okay? That's the Euro versus US dollar. Now, anything that has USD, GBP, Great Britain pound versus US dollar. As far as it has USD, the major pair. The minor pair now, moving on, minor pair are some ones that have other other strong currencies, strong currency, the trading market, such as like GBP, JPY, which is Euro. Okay? But there's no USD. You can have something like Euro, maybe Euro, JPY. And see, Euro is significant, JPY is very strong. But there's no USD. So you might have maybe AUD, JPY, Australian dollar. Then we have exotic pairs. Those are the ones that are smaller or emerging nation for economy. Something like all those, I think Iranian real, you have all those other Cyprus, all their currency, they are paying in USD or Euro. Those are small or CAD, CHF, Swiss franc. See those those ones have all those really those ones are exotic pair. And we have inside this, we have commodity currency pair. Currency pair that commodity currency pair. Now this one for country maybe one of the countries inside a pair like this really exports things. It's like, let's say NZD, Z, 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 D. Now, New Zealand is known for exporting agricultural, is known for exporting agricultural things, um, dairy products. Okay, so as far as is, it is known for just doing the mostly exports of commodities and rest. Okay, and it's a country so known as commodity currency pairs. Okay, we have stock market. These are like the Nasdaq that you hear. I don't know. Most people must have heard of Nasdaq. These are where Nasdaq, Tesla, and the rest. Okay, Nasdaq. And you have your Tesla owned by Elon Musk. Elon Musk, rather. Um, these, these are stock markets. Okay, where shares and bonds could be bought and sold by investors and traders. That's stock market. You can buy shares at Tesla and Nasdaq. All these ones companies. Stock market. We have commodity market. It involves buying or selling of raw products like oil, gold, right? The gold now is known as XAU because XAU, when you see XAU, gold, XAG is silver. So you have XAU, XAG. Okay? So XAU, the X stands for South Africa. Okay? Then AU, gold. Those who did the science classes will understand this. Okay? AU, gold, AG, silver. So the X is for South Africa. So you see XAU, don't be shocked. You think it's Chinese. No, it's not Chinese. The XAU means gold, XAG means silver. Okay, good. So those are commodities. Okay? Things that are gotten as raw material, oil. Now, how Forex trading works? Now, let's say you're buying a pair. You're buying a pair. Now, this pair, let's before we talk about it, let's talk about base and quote currency. You have your base and quote currency. In this currency pair, it's divided into two. You know, two of them came together. One is the base, one is the quote. So the base is the euro, quote is the USD. Yeah, base is the euro, quote is the JPY. Now, base, if you are buying, now let's go to how forex trading works. If you are buying this pair, it means that the base currency is strengthened. Okay, means you are betting that okay, euro will have more strength or dollar will go down. But if you are selling it, you are saying dollar will have more strength, both will now have more strength, or euro will go down. So you get the logic. But when you are buying, means this first one will either go up or this one goes down. If you are selling, it means this other one will go up. The second side, the quote will go up and the base will come down. Okay, so that's the logic. So now there's something called spread in trading. It is actually the difference between bid and sell price. Okay, it's actually a cost for a trade. When you're entering a trade now, you will not just carry out your money. No, they will charge you for entering a trade. So that is your spread. That's the best way to explain spread. Then we have what we call leverage spread. Spread SPREAD spread. We have leverage in forex trading. Leverage. Now it is actually the most powerful feature in forex. Okay, it allows you to control a large position with small amount. So leverage controls how you can trade. Okay, now let's say you have a $1,000 account. Good. And you are using a 1:1 ratio 50 leverage. Good. Let's use one ratio, around 1:50. That's not the ratio sign. Now it means and you have 1,000. It means you can control and you have $1,000. It means you can control trades that are 50 times greater than that your money. So 50 times $1,000 is 50,000. It means you can trade that your $1,000 up to 50. It's risky, but it means you can trade it. And the same way you can trade it up to 50, the same way you can fastly lose that 1,000. And if it's 1:5 ratio, it means you can control trades from without your 1,000, you can control trades of 5,000. Okay, if it's 1:2, without your 1,000, you can control trades of 2,000. Okay, so you regulate how you trade. Now in trading, we have two types of analysis. We have two types of analysis. Okay, we have two types of analysis. We have though there are three types of analysis rather, three types, but let's look at we'll list all of them. You have your technical. technical analysis. I'm using a letter. Tech, technical. Okay. You have your fundamental. Come and fund me. Sentimental. Now, so for technical analysis, it actually involves analyzing based on price movement. So you can see there's a trade. I think there's a trade I will analyze now. I'm currently winning profit on the trade. So this is technical by reading all these whole charts. Okay, by reading all these whole charts and arriving at this trade. Okay, taking this reading on interpreting this chart. This is what we call technical analysis. When we talk about fundamental, that's what maybe they'll say maybe a big man or somebody related in trade. Let's say when you're talking about USD now, if Donald Trump comes out and say, he says something that will boost the dollar, and you are listening to him off the chart, so that is fundamental. Okay, so that focuses on looking at the economic, social, and political factors that influence the currency. So if something, let's say now, if something happens, maybe interest. Okay, let's not go that far. Let's not go that far. If more people buy the dollar. Let's say people start the year. Okay, if you buy a dollar, they will give you one gold bar. Let's use that example. You are buying, maybe you have $1, you exchange and start using dollar. Give you one gold bar for every $100 you use. You see, most people are rushing. Dollar will start gaining value. That thing is off the chart, but analyzing through that aspect is what fundamental analysis. And technical is by reading all these candlesticks and the rest. Okay. Sentimental now is used to gauge how other traders feel. Most people now they just be like, but like say people they buy you, they go up. Okay, follow them. Let me follow them. It's going down. That is sentimental. Okay. Ehen. So now let's look at the basic market structure. Before that, okay, let's look at what we call order flow. Order flow is actually one of the basic parts in trading. Well, now we have left the intro to trading. Now we are going deeper. We hear order flow. It means something. It's the real time buying and selling activities of the market. It shows who is in control, who they lead, who is leading this market. Okay, that's order flow. It helps you to reveal where price is going to, where price is coming from. So you have bullish, just the way we have candlesticks. We have bullish order flow, bearish order flow. Okay, good. See how everything is. Now, let's go back to the charts like this. Now, for bullish order flow, it consists of a series of higher lows and higher highs. Don't me say higher lows and higher highs. Let's look at this. Let's look at let's go. Bullish order flow. Market is going up. Yeah. Then we have bearish order flow. The market is going up. Remember, I said when it's bullish, going up. Bearish is coming down. Okay? So bearish order flow. So each high, you can see that market is doing something similar. It's creating what? It's going higher. Now we have the higher high up here. Then we have follow my cursor. Then we have higher low down. Another higher high, then higher low. HH, HL, HH, HL. So higher high, higher low. It's all higher, going high, but the higher you have the high part, the low part. So it's higher, higher, higher low. Then here it's coming lower. You have your lower high, lower low. Lower high, lower low. Lower high, lower low. Okay? Good. So for market structure, let's move on to market structure. There are actually three different types of trends in the market structure. Trend of the market structure. You have an uptrend, downtrend, sideways market. So this now can be said that this is an uptrend. Market is going up. Downtrend, market is coming down. Then sideways, market is just ranging, whether going up or down. It's just within the same spot, just ranging. Okay, this is ranging market, up, down, within the same level. Okay. So, like I said, the uptrend has higher highs, higher lows, downtrend, lower highs, lower low. But here you have your supply and demand level. When you buy in demand, there's high demand on supply or support down. Now your support is actually what is supporting you on the ground, just like your floor. Resistance is what is like your roof, okay, above, okay. So the market now has three major trends, like I said: uptrend, sideways, downtrend. You have your uptrend, market moves up. Then you have your sideways, get perfect degree of all of them. You have your sideways side, or it starts coming down to a downtrend. So you get, I hope you get the gist. I hope you get the gist. Going to an uptrend, sideways, downtrend. Okay? Good. So now let's move on to something very simple that we call it. We have what we call, let's look at the real chart though, and let's see. So you can see this market now is coming down. As it's in a downtrend. Here it was going up. It's an uptrend. Okay. As it's going up, it's creating higher highs. For this up now, let's see, there's a higher low. Let's start here. Higher low, higher high, higher low, another higher high made here, higher low. Okay, that way. Okay, so you're going up, going down. Now we have what we call break of structure, or BOS. Break of structure. Now BOS actually occurs when a price moves above this higher high. So when price is set to break this former high, now the last record that is set, it breaks past it. Then you can now say, okay, um, price has created break of structure. Price has created break of structure. Okay, and look at it just this way. Price has broken the former place, create a new one. So for here now, so this one is known as BOS, or bullish BOS. Now BOS to the upside. You have BOS to the downside. It has broken the former low, create a new low. Now come back again, break again to go and create. Okay, so this is BOS, bearish BOS now, or downside BOS. Then change of character, it means when the market is now changing from maybe market that was buying, it now decided to turn. Let me connect this. Market decided to turn and sell. So this point now where it breaks, instead of it not breaking here and going up, it decides to just it decides to clear out this low and change and now start selling. This is what a change of character. Okay, a change of character. So break of structure is involved in all of them, but there's always either a change when it's changing from buying to selling or selling to buying. It's what you have a change of character involved, or what we know as market structure shift. Okay, it's going to be another video properly speaking of market structure shift. So I don't want to. Let's stick with change of character. The change of character is short form known as chalk. Okay, so let's stop here with the chalk and BOS. Okay, so you have your upward BOS, downward BOS. Okay, or bullish BOS, up down bearish BOS. Okay, okay, it breaks this former high or higher high to create a new one. So this place where you break that, it breaks it, break of structure. Yeah, break of structure. Okay, down to break of structure, break of structure. But when it stops buying now and wants to start selling, that point where it breaks the last, maybe from buying to selling, where it breaks the last higher low and breaks it down. That is change of character. Change of character. Okay, so that is all on the intro to forex trading. Okay, every other thing henceforth, we're moving into deeper into trading. Okay, that is it with the intro. Okay, so the comment sections are all open. Feel free to ask your questions in the comment sections. They will be tended to. And if you would love to reach out to me via WhatsApp, let me drop the official WhatsApp hotline 0912161887. You can reach out to me via WhatsApp regarding anything. Okay, good. And you could also check any of our social media handles. You check the bio wherever you're viewing this video. You check the bio, you'll see a link tree there. Any social media you search for, you search for Forex Doctor, you're gonna be seeing a trading post there. You can DM me on TikTok, Twitter, Instagram. You're gonna even if you check Telegram, you're gonna see our page, okay, our trading channel there on Telegram. We are active on all social. Yeah, man. Reach out. It's also going to be our main next class, Union 14 class, really by June. More intel on that will be coming very, very soon. You need to follow us on all social media platforms. Yeah, so you don't miss out on anything. So that's it for today. This particular video. Forex Doctor and your host, Doctor. Doctor. Goodbye, everyone.